Good morning. Today is October 5th. Long time no see. I was busy. Although I was not on YouTube, I practiced every day, almost, without weekends, except for weekends. But that's my excuse. Anyway, let's get started. To give you a sense of what was happening, Figure 26 shows the daily money outflows from the money market funds. This is a $2 trillion industry. You see the Lehman bankruptcy, and a couple of days later, you see the money market fund breaking the buck, which meant that it was unable to pay its investors $1 a share. Following that announcement, you can see that for 2 days, about $100 billion a day was flowing out of these funds. Within 2 days, the Treasury announced the guarantee program, and the Fed came in to support the liquidity of these funds. And as you can see, the run ended pretty quickly. This was an absolutely classic bank run and a classic response, providing liquidity to help the institution being run provide cash to its investors and providing guarantees. That successfully ended the run. But that was not the end of the story, because the money market funds were also being hoarding commercial paper, and as they began to face runs, they in turn began to dump commercial paper as quickly as they could. As a result, the commercial paper market went into shock. This is an excellent example of how financial crisis can spread in all different directions. Lehman failed. That in turn caused the money market funds to experience a run, which led to a shock in the commercial paper market. So everything is connected to everything else, and it is really hard to keep the system stable. As the money market funds withdrew from the commercial paper market, there was a sharp increase in rates in the commercial paper market, and lenders were not willing to lend for more than maybe one day to commercial paper borrowers, which in turn affected the ability of those companies to function and the ability of those financial institutions to fund themselves. Once again, the Federal Reserve, responding in the way budget would have had it respond, establish special programs. Basically, it stood as a backstop lender. It said, make your loans to these companies, and we will be here ready to backstop you if there is a problem rolling over these funds. That restored confidence in the commercial paper market. Figure 27 shows commercial paper rates. Once again, you can see the panic phenomena, a sharp increase in rates, which really understates the pressure because it does not include the fact that for many companies, they could not get funding at any interest rate. Or if they got funding, it was only for overnight or very short-term periods. The Fed's actions restored confidence in that market, and you can see the response. Rates came back down at the beginning of 2009. A lot of what I have seen discussing you probably did not read too much about in the newspaper. I was working with these critical markets. A lot of what I've been discussing you probably did not read too much about in the newspapers. What does that mean? I was working with these critical markets and providing broad-based liquidity to financial institutions to try to bring the panic under control. But the Fed and the Treasury also got involved in trying to address problems with some individual critical institutions. In March 2008, as I mentioned, a Fed loan facilitated the takeover A Fed loan facilitated the takeover of Bear Stearns by JP Morgan Chase, avoiding a failure of that firm. The reasons we undertook that action were: first, at the time, the financial markets were quite stressed, and we were fearful that the collapse of Bear Stearns would greatly add to that stress and perhaps set off a full-fledged financial panic. And second, we judged that Bear Stearns was solvent. At least JP Morgan Chase thought so. It was willing to buy the firm and to guarantee its obligations at very cheaper price. At cheap price. So by lending to Bear Stearns, the Fed was acting consistent with the proposition that it should make loans that are likely to be paid back. The Fed felt that it was well secured in making that loan. The second example, AIG, was very close to failure in October 2008. AIG again was the world's largest insurance company. It was a complicated company. It was a multinational financial services company with many constituent parts, with many constituent parts, many constituent parts, with many constituent parts, including a number of global insurance companies. But part of the company called AIG Financial Products was involved in all kinds of exotic derivatives and other types of financial activities, including, as I mentioned, the credit insurance that it was selling to the owners of mortgage-backed securities. So when the mortgage-backed securities started going bad, it became evident that AIG was in big trouble and its counterparties began demanding cash or refusing to fund AIG, and it came under tremendous pressure. In our estimation, the failure of AIG would have been basically the end. It was interacting with so many different firms. It was so interconnected with both the US and the European financial systems and global banks. We were quite concerned that if AIG went bankrupt, we would not be able to control the crisis any further. Now, fortunately, from the perspective of lender of last resort theory, although AIG was taking a lot of losses in its financial products division, underlying those losses was the world's largest insurance company. So AIG had lots and lots of perfectly good assets. Therefore, it had collateral that it could offer to the Fed to allow us to make a loan to provide the liquidity it needed to stay afloat. And so to prevent the collapse of AIG, we used AIG assets as collateral and loaned AIG $85 billion. It's almost to $1 trillion now. Later, the Treasury provided additional assistance to keep AIG afloat. Then it's over $1 trillion. That was highly controversial. The action was legitimate, we thought, first in terms of lender of last resort theory, because it was a collateralized loan, and the Fed has in fact been fully paid back. And second, because AIG was a critical element in the global financial system. Over time, AIG stabilized. It has repaid the Fed with interest. The Treasury still owns a majority of its stock, but AIG has been paying back the Treasury as well. I would like to emphasize that what we had to do with Bear Stearns and AIG is obviously not a receipt, not a recipe. Recipe for I'm always confused with recipe and receipt. Recipe. AIG is always not a recipe for future crisis management. First, it was a very difficult and in many ways distasteful intervention that we had to do to prevent the system from collapsing. But clearly there is something fundamentally wrong with the system in which some companies are too big to fail and moral hazard. If a company is so big that it knows that it is going to get bailed out, that is not at all fair to other companies. But even beyond that, too big to fail gives these big companies an incentive to take excessive risks where they will say, well, we'll take big risks. Heads, I win. Tails, you lose. What? So in both cases, I win. If the risks pay off, you make we make plenty of money, and if they don't pay off, the government will save us. That is a situation that we cannot tolerate. As I win, as you win. If the risk payoffs, we make plenty of money, and if you don't pay off, government will save us. That's a situation that we cannot tolerate. That's the moral hazard. All right. We cannot tolerate that.